Hey everyone, welcome back. Today I want to share something very personal. If you have visited my website letsvalueinvest.com or LVI, you might have noticed a page dedicated just to quotes. And it's completely free. I actually built this because during my own investing journey, these quotes acted like mental anchors. When you analyze a stock on Let's Value Invest or LVI, these quotes randomly pop up as you click through different tabs. I wanted to give users those same gentle reminders. Because let's be honest, I believe that wisdom compounding along with wealth is the real compounding machine. So I wanted everyone using LVI to have the same mental reminders while they do their stock research. Today, through these 5 quotes, I want to show you the foundation upon which sound value investing principles are based. How to protect your capital, how to find the right opportunities, what to buy, and how to survive the test of time. So, let's start with number 1. Rule number 1 is to never lose money. And rule number 2 is to never forget rule number 1. And that comes from none other than Warren Buffett. This sounds almost too simple, right? But after observing the market for years, I realized how brutal the math is if you violate this rule. Growing up in an Indian household, the concept of capital preservation was built into my DNA. We were always taught to respect money and protect what we have. But in the stock market, people easily forget this simple rule. They chase high returns and ignore the risk of losing money. Let me show you an example that changed how I look at this. So for this example, let's imagine 2 stocks over 5 years. Stock A has returns of 55%, 40%, 30%, then a massive drop of minus 65% in year 4, and finally a recovery of 30% in year number 5. The average return is 18% for this stock over 5 years. Stock B, on other hand, is much steadier. 18%, 22%, 17%, followed by minus 25% and a recovery of 27%. The average return for stock B is 12%. If someone just showed you the average return, you would likely choose stock A with 18%. It looks much better on paper. But which stock would you actually buy? Take a moment to think about it. Here is the mathematical truth. If you invested $100 in both the stocks, in stock A, because of that one catastrophic drop of minus 65% in year number 4, your $100 only grows to $128.36. And that is a 5.12% compounded annual growth rate. Why? Because when you lose 65%, you need a massive 185.7% gain just to get back to even. But in stock B, because you protected the downside and only dropped 25% in year number 4, your $100 grows to $160.43. That is a 9.92% compounded annual growth rate. A 25% drop only requires a 33.3% gain to recover completely. Even though stock B had a lower average return, it made you much more wealth because it avoided a big loss. And this is what Pulak Prasad talks about in his book, What I Learned About Investing from Darwin. He talks about 2 types of error, type 1 and type 2 errors. Now, what are type 1 and type 2 errors? A type 1 error is buying a bad business that results in a permanent loss of capital. This is a fatal flaw that kills your portfolio. And a type 2 error is simply missing a great opportunity, missing a stock that goes up. But you didn't lose anything. Your capital still remains in your pocket and it's safe. Warren Buffett's rules isn't about avoiding normal market volatility. It is about avoiding permanent capital loss, that type 1 errors. To sum up, if you focus on downside protection and avoid the big mistakes, the upside will take care of itself. So if our main job as investor is to avoid losing capital, how do we actually do that in practice? And this is where a powerful mental tool from Warren Buffett's late partner, Charlie Munger, comes in. It's a concept called inversion. Invert, always invert. Turn a situation or problem upside down. Look at it backward. Tell me where I am going to die so I don't go there. In life, our knowledge is often limited. When I face a tough situation and I don't know what to do, I simply ask, what should I not do in this case? By identifying the bad decisions and avoiding them, you basically maximize your chance of success. In investing, instead of asking how do I make 5 times or 10 times my money on a particular stock, you should ask, how could I lose everything here? For example, buying a company with high debt that can go bankrupt. Buying a company whose products are easily replaced by competitors. Or buying at an insanely high valuation. Once you make this list of what not to do, your job becomes simple. Actively avoid these mistakes. If you avoid the bad businesses and the hyped valuations, you naturally end up with a portfolio of strong, surviving companies. Simple enough, know what kills your portfolio and stay far, far away from it. Once you know how to avoid the bad setups, how do you find the great ones? You simply look for fear. I will tell you how to become rich. Close the doors. Be fearful when others are greedy and be greedy when others are fearful. This quote is again from Warren Buffett. And this was one of the very first quotes I read when I started my investing journey. At first, it sounds like simple, exciting advice, but over the years, I realized this is actually about deep psychology, crowd behavior, and a fundamental law of finance, mean reversion. In the stock market, emotions run high. When a stock is going up, everyone gets excited and buys at any price due to fear of missing out or FOMO. But history shows us that over long periods, everything reverts to the mean. What has gone up too high eventually comes down, and similarly, what crashes too low will eventually recover. Well, in most cases, if not all. Buying when others are panicking gives you a margin of safety, a big discount to what the business is actually worth. But a word of warning here. Being a contrarian just for the sake of it is very dangerous. Because most of the time the crowd is actually right. We should only go against the crowd when our deep research shows that the crowd is wrong. For example, if you buy a stock just because the price crashed without looking at the business, you will fall into what is called value traps. Buying dying companies that eventually never recover. So, what's the solution? Basically, do the hard work first, then have the courage to stand alone. So if we shouldn't just buy any cheap stock when the crowd is panicking, what should we be buying? This is where the next quote helps us. Focus on buying these companies when they are out of favor. When the stock is selling at prices well under what it will be when its true merit is better understood. Phil Fisher gave us this key in his classic book, Common Stocks and Uncommon Profits. You don't buy weak businesses just because they are cheap. You buy outstanding, high-quality businesses when they are temporarily out of favor. And this usually happens during a general market sell-off or when Wall Street gets obsessed with a temporary short-term issue. This was the shift that transformed Warren Buffett from a deep value investor who only bought cheap, struggling companies into a quality investor who focused on great businesses. To sum up, look for high-quality compounders when the crowd is looking away. Finally, how do we stay patient while waiting for our investments to perform? In the short run, the market is a voting machine, but in the long run, it is a weighing machine. We remember this classic quote from Benjamin Graham, the father of value investing. What this quote means is very simple, but extremely powerful for your peace of mind as an investor. In the short run, the stock market behaves like a voting machine. Stock prices move up and down based on daily news, rumors, earning whispers, macro events, and just pure crowd emotion. It sounds like just a popularity contest. A stock price can shoot up or crash down based on what is trendy today, regardless of how the business is actually doing. But in the long run, the market is a weighing machine. Over a 3, 5, 10 or 20-year period, the noise dies down. The market stops voting on popularity and starts weighing the actual fundamentals of the business, its earnings, its cash flows, and the assets it owns. Eventually, the high fades and the stock price matches the real value of the company. As long-term quality value investors, this tells us we shouldn't stress over daily stock price movement. Our job is simply to focus on the weight of the business. If the company is growing its earnings and cash flows, the market will eventually weigh it correctly and reward you. These 5 quotes are simple, but keeping them close has saved my portfolio more times than I can count. If you want to keep these concepts top of mind, start analyzing stocks on letsvalueinvest.com. As you research, these quotes will show up as quiet reminders. And over time, you will find yourself absorbing and applying this wisdom naturally. Which of these 5 quotes resonated with you the most? Let me know in the comments below. Don't forget to like this video, subscribe to the channel, and I will see you in the next one. Happy investing.